Hello, ladies and gentlemen, and welcome back. Well, many people are freaking out right now about the US inflation numbers, and rightfully so. They're super high and super worrying. The question is, have we already hit a peak on those, and do we have some lead indicators that are coming out over the next 24 to 48 hours that are going to shed some light on whether this inflation number is going to come up? The short answer is yes, and we'll be talking about that in today's video. We'll also discuss the interrelation between the market's prices and defended zones, because many people in our private and public Discord, credit to everybody out there, got this level yesterday and recognized the opportunity for a bit of an upward tick in the market. It was brutal early, but once the market opened, the rallies came through. And there are ways that you can find and get these. The question is the next step for the markets. Do we actually break through the defended areas and move back down to 3,500? Most people are bearish looking that way. Or do we actually now believe that we could see a squeeze here on markets pushing through our key 3880 area? Well, there's so much to break down and so many great levels on the markets around the world right now, including stocks, commodities, and cryptos. And we'll cover them all. See you soon, guys. So welcome back, everybody, to the daily show where we talk about everything to do with markets. If markets interest you, then consider subscribing. And of course, if you enjoyed today's content, why not give it a thumbs up? Let's begin by inflation and talking about the numbers. By now, most of you are aware 9.1% was the number. This was a huge increase. And of course, it's going to put the pressure on the Fed to raise rates. In fact, now the Federal Reserve may raise rates as fast and as high as 100 basis points after their next meeting. The Fed's going hard here, and they're going to have to go hard. We have some great insights, though, onto what interest rates are going to be doing over the next few months, and we'll talk about the next 6 months into the next 12 months in today's video, and how that's changed in landscape over the last couple of days. Whether you're buying luxury goods or buying used cars or anything like that, all of this points towards, unfortunately, downward pressure on those things right now, but there's so much more to discuss in what it means for the markets as well. So is the Fed about to trigger a significantly harder landing? Possibly, and actually probably. So this is where the things are changed. When asked if the Fed would cut rates in a scenario where unemployment was rising but inflation remained high, remember this is very likely. We're already seeing the tech sector basically sacking off a huge amount of staff. Basically, the Fed said, we can't fail on this. We really have to get inflation down to 2%. And this is during their June meeting. So what this is telling you is the Fed can't really stop. They'll have to destruct the economy to a certain degree to get this done. They need to curb inflation, and they must do it now. We all know the ramifications of runaway inflation, hyperinflation, and nobody wants that. If that happens, it's not going to be good. Some people already argue we're in hyperinflation. I like to think things are hopefully going to correct, and we need to go from the optimistic route here. So where is inflation right now? Well, no surprises. Inflation in the numbers really centers around gasoline, airfares, household energy, and transportation. That's the big levels here for the inflation levels. Basically, things like new vehicles, food at home, furniture, they're all just really expensive, big ticket items, huge expenses. And what we're going to probably see in the next 24 hours is the PPI number showing us a key level. Now, I have a feeling, and this is more of a guess, that the PPI number might come down, and we'll talk about that later on today's video. But of course, we need to just consider what information do we have at hand. Here's the daily national average for gasoline prices in the US. Technically, it is decreasing coming into July. Technically, this is a good thing. Now, we haven't seen a decrease for a little while, but we do know that since the Federal Reserve has really started hiking rates, they haven't been able to curb much just yet. It does take a delay. It takes a while to get through the chain. We talked about the bullwhip effect in the previous video, and there's so much more to discuss. Obviously, S&P 500 is in recessions. The bond market is so heavily inverted, which we'll talk about later in today's video, that it's almost assured that we're going into a recession. Obviously, the Fed is going to cause potentially a hard landing. That's because they have no choice. At this stage, it's out of their hands. They have to protect the economy over the long term. It's not about quick fix here. It's going to be the hard yards. And coming into December, coming into Christmas, unfortunately, I don't have the best news for all of us out there. It's probably going to see some really high rates in the US. Upwards of what we're seeing right now is 3.6%. Yes, I said that. The bonds market is predicting the federal funds rate will be at 3.6% come Christmas, December of 2022. S&P 500 recession averages point towards we have more to go eventually. Now, that doesn't mean it has to happen right now, but more to go eventually. The average recession has made a 32% drop. And as we know, that really kind of points towards a market sitting at around 3150, 3200 on the S&P 500. Goldman Sachs also have put that out in one of their little kind of secret kind of things, showing that that is a level that they're looking at very interestingly. For the rest of July, here's a bit of a quick rundown on the big days and the big notes. Obviously, the big one here is going to be that we have the PPI number coming out, and we'll find whether that front runs everything else. So here is PPI and here is versus CPI. You'll notice there's two charts. And basically the lighter kind of blue one often shows us a prediction of change before it happens. You'll notice over here, we saw the PPI number dropping, and then of course the CPI number dropped afterwards. It's like a forward predictor. This year it's been very similar. In 2021 into 2022, the PPI number blew through and then it continued up, and as has CPI. CPI is playing catch up to this number. I did a tweet about it just recently, talking about it, but in essence, the way that it works is basically the PPI serves as a leading indicator for the CPI. So when producers face input inflation, the increases in their production costs are passed on to retailers and consumers. So the PPI can often serve as a true measure of output in that it is not affected by consumer demand necessarily. It's like pure inflation in some ways. So let's see what this PPI number does. If the number comes down, what might we see in markets? There's a potential for an actual rally here in stocks, at least temporarily, potentially setting up for something we've discussed, which is a bull trap, a bigger rally, possibly through maybe even July. I know a lot of you don't believe it's possible. Anything's possible. We'll talk about it soon. And then into a, of course, inevitable crash at some point with a new low formed. We have to really play both sides. If you're a trader or an investor, you've got to understand that these things are possible, and then you don't want to fall into the trap if it starts to occur. Let's discuss copper. Obviously a good kind of level of demand in terms of how demand's working. They call it Dr. Copper. That's because every build out in the world, what happens? We need copper. Copper goes into all the builds. And since really June, copper is incredibly decreased, and this is showing the real damage that the Fed is doing to the economy, effectively the hard landing coming through. Demand destruction occurring here in copper, and copper is really predicting as also the forward interest rate is going to be dropping, and we'll talk about that a little bit soon. Dollar index, this is the hedge most people are using to get out of all the uncertainty in the world. The US dollar has been so strong. This is only a 1 hour chart, and it's been so strong in recent weeks and months. Everyone wants US dollars. Cash is king at the moment. We have seen the potential here of a bit of a topping pattern. Now, I don't know if I'd be trading it like a topping pattern at this stage, but notice the change of trends here. We have kind of the smaller change of trend, peak, trough, new higher peak actually in just before the CPI number, new trough, rally back. If it's going to sell, it needs to sell right now. Otherwise, new highs, DXY goes up. Notice here the two long leg doji candles. They show equilibrium or effectively orders in the system. So what this means is that this is now a very important level for the DXY, and it's either going to short through here and come on down, and that could be good for the stock market for the short term, or it's going to bust through and possibly keep moving up. You've got to be very careful here when you're trading US dollars at the moment, but cash still could be one of the best trade concepts of 2022 into 23. Let's move over to the US 2-year. What happened after that massive inflation print? Well, frankly, the US 2-year went up. Now, this is where things get interesting. This is the US 2-year, 3.2%. The US 10-year, 2.8%. 9%. So if we put US02Y versus US10Y, which is how you create the yield inversion, this basically means the short date is above the long date. What it's telling us is US recession. Whenever the bond market does this, it says we see sickness in the future. The thing is, the sickness is actually quite close, and I'll demonstrate that in just a second here. But this is the US 2 versus 10. Now, if we actually scroll this out, this is the worst read now in terms of inversion that we've basically seen through all of the history on this chart. Even 2000 hasn't seen inversion this high. So it just shows you how much destruction the Fed is going to have to do to rates. To demonstrate this better, let me bring in some exhibits here. So we'll bring in the exhibit of September rates, and we'll have a look at September rates. They're now sitting at 2.5%. This is, remember, we're at 1.75 at the time of this recording. So this is saying that we're going to need to do easily 75 basis points, and it's already going above that, pushing in the percentage chance of 100 basis points from the Fed in the next rate hike. That's what they're kind of saying. They're saying, yes, we think we're going to need to push to somewhere around either 2.5 or even 2.75% over the next couple of months. Coming into December of this year, we're going to be even higher. Let's have a look here at the October rate. The October rate is sitting at 3.24%. So that's saying another huge hike, probably 75 basis points at the next meeting where they're going to rate hikes. This is a huge spike. Look at this chart. It's real business. You know, this is going to have a massive effect on used cars. It's going to have a massive effect on luxury goods. All of those things were super inflated. I mean, if you're looking at this, most people don't know this. Remember, you guys are privy to big knowledge, not so much on this channel, but just the fact that you're interested in this section and this idea and this hobby and this business that is trading and investing. I mean, you know, 3.2%, no one knows what they're coming for them. They have no idea. And then we hit December, 3.66% on the Fed rate. This is real. This is what the bonds market is telling us the Federal Reserve is going to have to do to curb inflation. And just remember, then we get into 2023, we go into April, it's 3.62, and then we go into September, and it comes down to 3.19. So basically, the Federal Reserve is going to do this. Massive spike, cut. Why will they have to cut? Because they're going to have to support the economy. It's your job as an investor and trader to recognize this and then to think of strategies around it. Maybe you want to wait until the cut happens. The market will already be most likely recovering before that point, but you might want to then see how that plays out. There's whole different ways that you can use this, but what an amazing thing that's about to happen to us. I mean, it's bad. It's an amazing bad, but it is something that you don't often see. And you can tell I'm kind of like, wow, this is really happening, because to say 12 months ago that the US Fed rate would be at 3.6%, hey, I would have not believed it. You've got to believe the unexpected. The market can do anything. It's not so much that it's crazy, it's just the reality that we live in. Let's move over to gold right now. What's happening with gold? Well, frankly, nothing. No one's really bidding gold too much. And we will update this if we see money flows going back in. At this stage, gold has been tanked recently. It fell through our last defended zone. Remember the word defended zone, because once things go through, they tend to fall to the next level. We are at the next level. We're starting to find structure, but I would say profit takers are probably taking a bit of profit. Shorters may still be in, and buyers probably can't show the commitment yet. We'll come back to that chart. US oil, what's going on in the oil world? Are we seeing oil going up? Not really. It's stabilizing around a pretty key level. Again, a bit of a defended zone. At the moment, the trend is down. Peaks, troughs, lower peaks, lower troughs, potential here to move through. Pretty big deal if it gets underneath this zone. With oil, we could even see a bounce first. Be very careful in this market. It's at that kind of level where if you're feeling bullish on oil, sure, but I don't like the way it's come in so far. A lot of people will be looking for it to break 105 kind of 20. And once it does that, they'll be looking at doing this. Boom, boom, and then taking it long. I'm not so sure that's going to happen though at this stage. Long leg doji, which is here, the high and the low, the indecision. It's kind of showing us that the market is cool with this level for now. We'll find out where it goes. So some stocks. What happened on the stock market? Well, it was down and then it was up. And a lot of people were left scratching their heads going, what the hell just happened? I should have been shorting that thing all the way through. It should have kept going. Well, yes and no. Was it a bad read? Sure. Did the market kind of know it was coming? I would say yes. I mean, the White House, as we reported in the previous video, literally came out with the damage control team running around like headless chickens saying, no, don't worry. It's the worst rate we'll ever see. It's all over. It's all good. So I think the market already prepped and knew this, but it also can create, like, if we get an interesting PPI number, a potential boom here in markets as well. What if the PPI predicts that inflation will come down? It doesn't mean that inflation's gone, remember. It just means the Fed's got to still raise the rates. The market will still probably be lower later on, but we could get that little relief rally. So Tesla bounced. It was basically a decent proxy for the Nasdaq for the day. We opened down, we rallied through, we ended up 1.7%, but the overall gains could have been bigger if you were there in the morning session. And we ended up closing in nowhere land. So unfortunately, Tesla doesn't help us too much. We've got our resistances up here at 760. We've got our supports at 628. That's just pretty much where it is. Let's move over to the DAX. Anything happening in the German market, the European market? Not really. Little bit of a rally, obviously previous days, and just a slow degradation of price here. If you go down to the smaller time frames, such as the 1 hour and 2 hour, there is a potential that the DAX is setting up for what we call an inverse head and shoulders, which is a left shoulder, a head, a right shoulder, and a movement through. Notice this trend line that's coming down as well. Potential here is that there could be buyers coming in. I think the news, the PPI, is going to be the catalyst if it does end up finding buyers. And if we get underneath this 12.6, I think Europeans should be a little bit scared. At that point, probably the S&P 500 will be under the defended zone, and we may go way lower. So it's a very important week this week. Let's move over to the Nasdaq. What happened on the Nasdaq? Gapped low, bounced up. The Nasdaq was probably the best percentage trade. If you managed to get the lowest point of the day to the highest point, it was around a 2.73%. But this doesn't really tell the full story. We'll have a look here at the Nas futures, and you'll notice how spiky it got. Now, this is the story that I wanted to mention. Notice this level, 12,000, just below 12,000, and the market spikes before the CPI print and then dumps on down. This is what we call a very large supply zone. So basically, the market has constantly gone to that level, and there are orders sitting here that were short. For the bulls to regain control and change the trend, they must push through this level. So basically, if we get through 12,000, I think we'll snap not only this high, but probably move up for a little bit here. Maybe a few days, maybe a few weeks. I'm not too sure yet. But certainly things would look a lot better. This is a huge bear zone. Bears all over this. They're full on salmoning the crap out of this. It is salmon season, and they are looking for shorts. You can tell by the spikes, by the way that the market comes to these prices. The defended area down here on the Nasdaq couldn't even get down there before buyers came back in. But the main reason was because of the S&P 500. This is the level we had on the previous session. And when you look at the futures, you'll see what we were talking about. So here's our defended zone, 3740, 3750. The box area we like so much. Current trends, very important. The current trend for the day is actually moving towards the upside still. Once we bust this though, things change very much so, and they could get a lot weaker. But the current trend is actually to the upside. Now, if you go to the smaller time frames, such as the 1 hour or lower, the current trend is to the downside. So this is where all of these special supply and demand zones come in, the support resistances as well. We have the demand zone, the defended zone, 3740, 3750. We saw it bounce off that area. Anyone that was joining us in the private community, click on the links down in the description below if you're interested in getting involved. Just even join this free 7-day trial. Watch the video I did on the previous one live into the market open. It was a great kind of class on seeing structure, patience, react, don't predict. If you're part of the member in the community, put a comment down below if you enjoyed that session. It was pretty good. A lot of people in the public Discord as well got this trade. They recognized the opportunity of the defended zone. They waited for the structure, and then they picked it up. And even though it may seem counterintuitive to the fear everyone was feeling, just remember some of the best trades sometimes don't feel good. But they are actually the right trade, but they don't feel good. They feel really bad because you're going against other people. Now, you are obviously using technical analysis. You're using the correct levels. You're recognizing those zones. But ultimately, it still feels really bad. The sellers would have been pretty happy with themselves early, and then they got pretty sad as the market rallied. And then, of course, at the time of this recording, we've rallied. We've come back down and then started rallying again. Now, we're coming into big bit of news. We're at kind of the bottom of the trend line. Could we bust through? Absolutely. If we get through 3880, will things change to the upside? Yes. So the trend will actually change to the upside. Let's take a look at this right now. So where it all happened was here. We go up, down, up, change trend. Once we changed trend, everything became more towards the short side. You could take longs, but you had to take longs very strategically, have the patience. It all became short. Then we've entered into the defended area, which we hope defends. Obviously it gets through here. More shorting is no doubt coming, I would think, on these charts. But here is the zone that's interesting to me. Notice the 3880, the touches. Then we get the 3875, the touch again, and it instantly shorts off. Before the CPI print, remember the Nasdaq that we just looked at? Instant spike, dumps off that level. What that's telling us is that, again, there are probably orders sitting here, and that this is a very important level moving forward. For the market to change to the uptrend on the 1 hour plus, it's going to need to move past this 3880, and everything in here is really more of a scalp and noise kind of trade. So it's going to be tough to figure out exactly what's happening ahead of this PPI, but as I always say, maybe the reaction, that is figuring out what it does, the direction it wants to go in, and then trading past that point could be the best course of action over the next few days. What an important zone here for markets. Super interesting. Let's move over to options. We've got max pain actually creeping up again. So funnily enough, max pain is higher than the current market price. 390 is where max pain is coming into the Friday options expiration. This is the third week options expiration. For anyone that doesn't know what that is, basically back in the day, options used to be just monthly. And it would always be the third week, and that would be the biggest one. It still remains the biggest options expiration point in the month. So it's the one you usually pay most attention to. I've noticed in the last 24 hours of trade, quite a few people have opened up 380 puts. Could that be retail opening these puts and they're about to get punished? I would say it's very possible. Very possible. 370 puts have been sitting there. The 380 puts, suddenly there's a lot of puts, and it looks like at 400, there's almost like an equal amount of puts and calls. So this is pointing right now that the market should recover if max pain is going to be achieved. It doesn't mean it's going to, it's just an interesting concept to have on your charts. Over to Bitcoin, recovery did happen here, still stuck between two zones. Unfortunately, we're not too interested in Bitcoin until we actually find some clear direction, but at least it's accumulating. At least it's holding this zone. It is near the demand level, so if you're feeling bullish, maybe that's the level, but again, it has to be based on actually seeing the stock market come through as well. If you haven't already, come and follow us at FX Evolution on Twitter or in our Discord community. 10,000 members there, private community, amazing people. The community is just amazing on the internet. You know, you guys have just made this channel amazing, and it's thanks to you, really. We're almost at 100K, all these things. Thanks so much. And remember, the calendar report. The big one is going to be the PPI. Now, I usually don't care about PPI too much, but it's coming out 1 hour before the New York Open, before the US stock market opens. Will this lead to show us maybe inflation is actually coming down? If it does, there's a chance that maybe the market can actually bull. And then even though I still think it's a false rally, and however long it goes, that would still be false, it would be what I would call the 4D chess move of the stock market if they could pull that one off. A lot of people don't expect it, and most people are bearish. I'm sure many people in the audience are, and rightfully so. Thanks so much, guys. Have a great day. Subscribe if you enjoyed the content, and give us a thumbs up. Bye for now.